Hello, Boris. I was wondering if you could help me out with keeping my money safe.
Of course, Cindy. Have you ever heard of the Little Book of Safe Money by Jason Zweig?
Why no, Professor, I have not.
I highly recommend it. Zweig talks about taking risks. He has a set of commandments that are simple and straightforward. They basically say that you shouldn't take risks you don't need to take, don't put money at risk you cannot afford to lose, and don't take risks that don't have a clear reward.
So you mean basically don't gamble?
Well, actually, it isn't quite that simple. That's a good start, but there's much more you need to know. For example, it's important to be liquid. To accomplish this, you must have a buyer, a seller, and a way to complete trades at a price that's reasonable for both parties. Stocks are a good example. Real estate is iffy. An art collection wouldn't be good. Do you understand?
Let's see. Stocks are liquid because they are constantly traded in a fair way. Real estate is subject to many market factors, like the market crash in 2008. And an art gallery. Is that not liquid because there's no real good way to trade at low, reasonable costs?
Exactly. You also have to look out inflation risk, your health, your location, your professional future. Those are all risks that are often overlooked as people invest.
Professor, is there any way to protect against these risks?
Why, yes, Cindy, there is. There are investments that will let you hedge against all of these risks, from treasury inflation-protected securities to long-term disability insurance. That should be part of an overall plan.
Are there any other risks I should know about?
Why, yes, virtually everything beyond cash introduces some sort of risk, even treasury notes and money market accounts. Keeping some money in cash helps hedge all of the risks across your portfolio.
This all seems so discouraging. Isn't there anywhere I can trust?
The most trustworthy guarantees usually come from the federal government in the form of things like FDIC insurance, which are backed by the full faith and credit of the government. Although, if the government fails, all bets are off on many, many, many things. You don't have to worry about that though, because if that happens, no one's money is safe.
This all seems so confusing.
It's not that bad, Cindy. Read the book, it will really help.
What else can you tell me about stocks, Professor?
Don't reach for the highest yield, reach for small increment yields that have lower fees and costs. Example, bond index funds. Treat stocks as though they're likely to earn better long-term returns, but not guaranteed, meaning they need to be mixed with other investments with lower risk, like cash. Don't worry about stock prices. Instead, invest in the stocks of businesses you know well and you know are well run.
What else can I do?
Well, if you cut your personal spending in areas that work for you, you can easily come up with more money to invest and prepare for your future, comparable to a 1% interest on 10,000 investments.
What can I avoid to help me?
Ultra ETFs, those that are leveraged in other investments, incredibly risky, avoid them like the plague.
What can you tell me about hedge funds?
Hedge funds also carry a substantial amount of risk, because hedge funds often operate in secret. The name Bernie Madoff comes to mind. Why do hedge funds have such a reputation? Survivorship bias, the ones that survive get to tell the story, ignoring the mountain of failures, and backfill bias, the losing funds are never reported at all, are two big reasons.
Well, Boris, I'm late for class. Is there anything else you can tell me before I leave?
Commodities are incredibly volatile, showing huge gains and losses almost every year, requires a deep understanding. If you simply must invest in commodities, balance those investments with some very stable investments. When in a long-term relationship, keep your investments open to your partner because they may have something to counterbalance your investments. Don't take everything you hear or see for face value. Sit on a good deal for a day and see what happens while you do some research. Don't sign up for an advisor unless you've done lots of legwork and are very confident about your choice. A simple rule of thumb: if someone sends you an email or calls you about a particular investment, ignore it. Be patient. Ride the crests and the valleys. Only sell when you have a personal reason to sell, not because you think you can time the market. When people talk about something that beats the market or claims large returns, it's going to be bogus. Even more important, if such returns did exist, then everyone would quickly invest that way and such returns would become the norm. They're not. Stay away from such nonsense and use some common sense.
Wow, thank you again, Professor. Hey, got any time for something fun?
What did you have in mind?
The robot, of course. What were you thinking?
Oh, of course.